You are sitting at your kitchen table. The mail just arrived. You pull out an envelope, standard white government logo in the top left corner, Canada Revenue Agency. You open it. Inside is a notice of reassessment, and the number printed on that page is not a small correction. It is not a clerical adjustment. It is a demand for tens of thousands of dollars in capital gains tax on a property you have owned for over a decade. A property you never thought of as a tax problem. A property you were counting on to fund your retirement, pay off debt, help your kids with a down payment, or pass to the next generation of your family intact. And the reason this letter arrived has nothing to do with fraud. Nothing to do with deliberately hiding income or filing false returns. It happened because of a single change buried inside the 2024 federal budget that the majority of Canadians either never heard about and immediately dismissed as someone else's problem. That dismissal is exactly what we are going to dismantle today, because that one assumption, "this doesn't apply to me," is the most expensive assumption a Canadian property owner can make right now. Before we get into the mechanics, let us spend a moment with the comment section. Over the past several weeks, since we first started covering the 2024 capital gains changes on this channel, the response has been extraordinary, and the divide in the comments is one of the most instructive things we have seen in years of running Canada Property Watch. On one side, you have comments from viewers saying things like, "This is pure fear-mongering. The government would never use this rule against ordinary working Canadians. The threshold protects most people." On the other side, you have comments that are genuinely heartbreaking. People saying things like, "My mother passed away last spring, and the tax bill on her cottage alone nearly forced us to sell it in 3 weeks." Or, "I had no idea my rental property gain was this large until my accountant showed me the new numbers. I almost passed out." Both of those groups of people are watching this video right now. And here is the uncomfortable truth. The person who is confidently dismissing this as fear-mongering is the one who is walking closest to the edge of the cliff. So let us establish the foundation. The 66.7% capital gains inclusion rate is not a rumor. It is not a proposal that was floated and abandoned. It is not an exaggeration invented by opposition politicians or financial media looking for clicks. It was legislated through Canada's 2024 federal budget, introduced by the Department of Finance Canada, and it came into effect on June 25, 2024. It represents the most significant structural change to capital gains taxation in this country in more than 2 decades, and yet the majority of Canadian property owners, homeowners, investors, and small landlords alike do not fully understand what it does, who it applies to, or how dramatically it can affect the financial outcome of a property sale or the settlement of an estate. The misunderstanding starts with the language. The phrase 66.7% capital gains inclusion rate sounds technical, and most people either stop reading at that point or they reach for the number that feels most familiar, the $250,000 threshold. And they use that number as a comfort blanket. My gain won't be $250,000, so I'm fine. Let us take that comfort blanket away, gently but firmly, because the math does not work the way most people think it does. Here is what the inclusion rate actually means. It does not mean the government takes 66.7 cents out of every dollar of your capital gain. The inclusion rate refers to the percentage of your capital gain that gets added to your taxable income for the year, and then that taxable income is subject to your regular marginal tax rate. Under the rules that existed before June 25, 2024, the inclusion rate was 50% for individuals. That meant if you sold an investment property and your capital gain was $600,000, only $300,000 of that gain, 50%, was added to your taxable income. You never paid tax on the other $300,000. That was the old deal. That was how generations of Canadians built wealth through real estate, with a relatively manageable tax cost at the point of sale. Under the new 2024 rules for individual Canadians, the 50% inclusion rate still applies, but only to the first $250,000 of capital gains realized in a single taxation year. Every dollar of capital gain above that $250,000 threshold is now subject to the 66.7% inclusion rate. And for corporations and most trusts, there is no threshold at all. Every single dollar of capital gain is subject to 66.7% inclusion from the very first dollar. This corporate level change is something we are going to come back to because it affects a large number of small landlords and investors who hold property through numbered companies or family trusts and may not have been adequately warned by their advisors. Let us put the individual numbers into a scenario that reflects what is actually happening in Canadian real estate markets. You are a homeowner in the Greater Toronto area. Back in 2008, you purchased a small investment condo as a rental property. You paid $285,000. Over the following 16 years, you made some improvements, new flooring, updated appliances, a bathroom renovation, and your documented adjusted cost base sits at approximately $320,000. Today, in 2025, that same condo is worth approximately $870,000. You decide the time has come to sell, but your capital gain is $550,000. Under the old pre-June 2024 rules, here is what happens. 50% of your $550,000 gain, so $275,000, is added to your taxable income for the year. If you are in Ontario at the highest marginal rate of approximately 53.53%, your tax bill on that capital gain is approximately $147,200, a significant amount of money. But you understood it was coming, you planned around it, and you can absorb it while still walking away with over $380,000 in net equity from the sale. Under the new rules, here is what changes. The first $250,000 of your $550,000 gain still gets the 50% inclusion, so $125,000 gets added to income from that portion. The remaining $300,000 of your gain, the amount above the threshold, now gets the 66.7% inclusion, meaning $200,100 is added to income from that portion. Your total taxable income addition from this sale is now $325,100 instead of $275,000. At that same Ontario marginal rate, your tax bill has jumped to approximately $174,000. That is roughly $27,000 more in tax compared to the pre-June 2024 rules on the exact same property with the exact same gain. $27,000 in additional tax. Not because you did anything differently, not because the property performed better than expected, purely because the rules changed. Now multiply that across a real estate portfolio. Multiply it across an estate that holds 3 or 4 properties accumulated over a lifetime of careful saving. The numbers become genuinely staggering, and here is the piece of this story that has been almost completely absent from mainstream media coverage. The narrative around the 2024 capital gains change was constructed very deliberately around the idea that this was a measure targeting the ultra-wealthy. The language used in the budget documents and in government communications emphasized fairness, making the wealthiest Canadians pay their share, and reducing the advantage that capital gains income has traditionally held over employment income. That framing was enormously effective at causing ordinary middle-class Canadians to stop paying attention. They heard tax on the wealthy, they decided it did not describe them, and they tuned out. But here is the reality that the framing obscured. In the major urban centers of Canada, and this is no longer limited to Toronto and Vancouver, it now includes Ottawa, Calgary, Victoria, Hamilton, London, Kelowna, and Halifax, the appreciation in residential and investment real estate over the past 15 to 20 years has been so extreme that an enormous number of ordinary working Canadians are sitting on unrealized capital gains that easily clear the $250,000 threshold. These are not people who would describe themselves as wealthy. They are retired teachers who bought a rental property in 1997 as a pension supplement. They are trades workers who purchased a duplex in 2004. They are small business owners who invested their savings into a couple of condominium units instead of the stock market. They bought the asset, they held it. The market did what it did. And now, when they go to sell, whether by choice or because of life circumstances like health, divorce, or retirement, they are subject to a tax increase that was sold to them as aimed at someone else. But the most vulnerable group of all, and this is where this conversation becomes deeply personal for a large portion of this audience, is the inheritance group. Canadians who have either recently inherited property or who are anticipating inheriting it from aging parents. This group is being set up for a financial shock that many of them have absolutely no preparation for, and the 66.7% inclusion rate makes that shock significantly worse than it would have been under the old rules. Here is the mechanism. When a Canadian taxpayer dies, the Income Tax Act deems that they have disposed of all of their capital property. Every investment, every secondary property, every rental unit, at fair market value on the date of death. This is called the deemed disposition at death. The deceased's estate, through their final tax return, must report and pay capital gains tax on the difference between the property's adjusted cost base and its fair market value at death. There is no option to defer this tax indefinitely. There is no election that makes it disappear. The estate owes the tax. Now consider the numbers on a property that has been in a family for decades. A cottage purchased in Northern Ontario in 1983 for $55,000. Today, that same property is worth $1.2 million. The deemed capital gain at death is $1.145 million. Under the new 66.7% inclusion rate, the first $250,000 of that gain gets the 50% inclusion, so $125,000 added to income. The remaining $895,000 above the threshold gets the 66.7% inclusion, so $596,650 added to income. Total taxable income addition from this deemed disposition is $721,650. At the top Ontario marginal rate, the estate's tax bill on just this one property is approximately $386,000, and that tax has to be paid. It is not optional. It does not go away because the heirs are emotionally attached to the property or because the family has owned it for 40 years. The estate pays, or the asset gets sold to cover the bill. For families with multiple properties in the estate, these numbers stack, and the children or grandchildren who inherit are left with a choice that is not really a choice at all. Either come up with hundreds of thousands of dollars in liquid cash that most families simply do not have sitting around, or sell the asset under time pressure, often below market value, to satisfy a tax liability that arrived with almost no warning. This is not a theoretical future risk. This is happening right now in probate courts and at kitchen tables across Canada. The 2024 budget change made this specific scenario materially more expensive for every estate that goes through it. So what do you actually do with this information? Because we do not run this channel to generate anxiety. We run it to generate action. And there are specific, concrete moves that still make a real difference, but only if you understand them clearly and move on them before circumstances force your hand. The first and most powerful tool still available to individual Canadian homeowners is the principal residence exemption. Under current Canadian tax law, the capital gain on the sale of a property that qualifies as your principal residence is fully exempt from capital gains tax, not partially sheltered. Not subject to a reduced rate, fully exempt. There is no dollar cap on this exemption. A property that has appreciated by $2 million can qualify for a full exemption if it meets the criteria. The exemption is the reason why the family home in Canada has historically been one of the most tax-efficient wealth-building vehicles in the world, and it has not been eliminated by the 2024 budget changes. But, and this is a significant but, the CRA's enforcement and audit activity around principal residence designations has intensified substantially over the past several years. The rules around what qualifies, how, and when you formally designate a property, and what happens when you own multiple properties simultaneously have become more complex and more aggressively applied. You can only designate one property per family unit as a principal residence for any given tax year. If you and your spouse own your primary home and a vacation property, only one of those properties can be designated as your principal residence for any year you own both. The gain on the undesignated property does not qualify for the exemption, and if you have not been formally filing your principal residence designation with your tax return when you sell a property, something that became mandatory in 2016, you may have a problem that has been quietly building without your knowledge. The second tool is the lifetime capital gains exemption. This is an exemption that most Canadians who are not running small businesses have simply never heard of. For 2024 and beyond, eligible individuals can shelter over $1 million in capital gains from qualified small business corporation shares and qualified farm or fishing property from capital gains tax entirely. This is a separate additional exemption that stacks on top of the principal residence exemption. For the right set of circumstances, a small business owner looking at an eventual sale of their corporation or a farming family transitioning land ownership to the next generation. This exemption represents a potential tax saving of hundreds of thousands of dollars, but it only works if the asset is structured correctly, if the corporation shares are properly qualified, and if the transition is planned well in advance. This is not a last-minute tool. It requires years of preparation in most cases. The third area, and this is the one that is most urgently time-sensitive for the largest number of people in this audience, is the estate and succession planning recalibration. If you have a will that was drafted more than 2 years ago and you own a secondary property, an investment property, or a rental unit, your estate plan was built around a tax framework that no longer exists. The inclusion rate change that took effect on June 25, 2024 materially changed the tax liability that your estate will face. The life insurance coverage that was sized to offset your estate's tax bill may now be undersized. The trust structures that were built to minimize the deemed disposition tax may need to be restructured. The plan your accountant built for you in 2021 or 2022 may have made perfect sense at a 50% inclusion rate and may be inadequate or suboptimal at 66.7%. Revisiting your estate plan is not something you do after a health event forces the issue. It is something you do now, proactively, while you have the time and the freedom to choose the structure that works best for your family rather than accepting the default that the Income Tax Act imposes on estates that have no plan. Now, there are 3 actions you should be taking in the next 30 days, and these are not vague suggestions. They are specific moves with measurable financial consequences. The first is to reconstruct and document your adjusted cost base on every non-principal residence property you own. The adjusted cost base is not simply your original purchase price. It includes the purchase price, plus all eligible capital improvements made to the property during your ownership, renovations, additions, major repairs that extend the asset's useful life, plus certain transaction costs like legal fees paid at acquisition. Every dollar of eligible improvement that is properly documented and added to your adjusted cost base is a dollar that reduces your future capital gain and therefore reduces your future tax bill. Many Canadians are significantly overestimating their capital gains exposure because they are only counting the purchase price and ignoring years of improvements. Pull out your old permits, your contractor invoices, your hardware store receipts. Reconstruct a paper trail. If you are missing documentation, start collecting what you can now. Because trying to do this reconstruction after a sale has closed is exponentially harder and less reliable. The second action is to retain a tax professional who works specifically in the area of real estate and capital gains planning. Not a general practice accountant, but a specialist who has been actively tracking the 2024 budget changes, who has read the technical guidance from Finance Canada, and who can build out a tax model for your specific situation using current numbers. This conversation will cost you a few $100s for the initial engagement. The exposure that a properly informed plan can help you reduce or eliminate could be measured in the tens or hundreds of thousands of dollars. The asymmetry of that trade is overwhelming. And yet, the majority of Canadian property owners never have this specific conversation with a qualified professional. The third action is the hardest one for most people, which is exactly why it gets avoided the longest. If you have aging parents who own real estate in Canada, and if you have not sat down with them with their professional advisors present to map out what the estate plan currently looks like and what the tax consequences of the current plan are under the post-June 2024 rules, that conversation needs to happen now, not at Christmas when it might come up organically, not after a health crisis forces the issue. Now, the decisions that get made deliberately with adequate time and professional guidance are categorically better than the decisions that get made in the middle of grief under a tax deadline, and with a large bill arriving. The difference between a proactive estate plan and a default estate outcome under the Income Tax Act is often measured in six figures for Canadian families with meaningful real estate holdings. The direction of travel in Canadian tax policy around real estate is not ambiguous. Between the underused housing tax, the expanded principal residence reporting requirements, the increased capital gains inclusion rate, and the growing data sharing infrastructure between municipalities and the CRA, the federal government has made its priorities very clear. Real estate wealth, specifically the large, unrealized, historically undertaxed appreciation sitting in Canadian properties, is a revenue target that is not going away. The window for taking control of your tax position is not permanently open. It is open right now, marked today, for people who act on the information available to them. The Canadians who come through this period with their financial position intact are not necessarily the ones who earned the most or took the biggest investment risks. They are the ones who understood the rules as they actually exist, built a plan that reflects those rules, and took action while they still had the ability to choose their timing instead of having their timing chosen for them by a CRA reassessment letter. Now, if you think the capital gains inclusion rate is the most aggressive tool the CRA currently has in its arsenal against Canadian property owners, you are not fully informed yet, because what the agency is doing right now with building permit data sharing, hydro usage pattern tracking, sand contractor account forensics is a completely separate layer of exposure that affects anyone who has done significant renovation work on a Canadian property in the last 3 years. Most of those homeowners have no idea that the flag has already been placed on their file. We cover exactly how that system works, what triggers it, and what you need to do if you have pulled a permit or completed a major renovation in the next video on this channel. Watch it before you assume you are clear.